Masha, let's talk about India. The rally that we've seen so far in the Indian markets, while you have characterized it for the entire emerging market universe, how does India stand out? Primarily because we come out of a year where we saw a fall of 25%. India was the worst performing market.
Well, I think some chickens came home to roost, and India was the most expensive EM market. And if you were to look at the valuations today on the price to book value, it's actually in the bottom sort of 4 markets based on price to book versus profitability. So we have seen a pretty strong de-rating of the market, some for very, very good reasons. One is the policy conundrum and the corruption cases that have come to the fore and have slowed structural reforms and industry reforms that needed to happen. Second was the realization, I guess, by the market that promoters were growing businesses far ahead of what the internal cash flow generation would allow. So a number of those franchises where promoters had fingers in every pie have seen a day of reckoning. And I think that the very bad habit of financing yourself through equity offering every 18 months, that day of reckoning, hopefully will teach a lesson to the company managements going forward. So if I were to think about where India is today, value has reemerged, yet we clearly need to go through the corporate earnings season to see whether that extra capacity that has been built in India over the past few years is going to take a toll in returns. Clearly quite a bit of supply has come through, and we need to see the story of margins and how those would progress in the coming year.
So is there a tactical position in India right now?
I think there is a case that could be made for owning mid-cap India. There are a number of stocks that are looking very, very cheap indeed, and if you see the credit crunch being averted, working capital issues easing, I think some of these companies will do very well.
But India is not an overweight as of now. I mean, we've come out of a year where there was a consensus underweight on India. You think that will slowly start changing and perhaps move more towards a neutral stance, and maybe then by the end of the year close out with an overweight?
Again, we tend to take a stock-by-stock approach because we tend to think that we can find other factors globally where we find value and we could see the same price appreciation. But I think you're right, there is a number of long-standing bears on the street on the sell side that have moved more towards neutral to overweight on the basis of value.
You have liked the infrastructure space, particularly with regards to India. How are you profiling or picking infrastructure companies there?
Yeah, liked, I think, is a strong word. We noted that clearly price depreciation in the area has been very dramatic. So you have seen clearly this year a number of the stocks, take a GVK, GMR, Jai Prakash Associates, those stocks have done very, very well from an incredibly distressed areas. However, to see these stocks performing, we need to see the story of funding and self-funding coming together, because if you're buying any of the stocks today, you must be very cognizant of a potential for future equity issuance, and that this is something that investors tend not to like. So we are able to find stocks, and I'm not at liberty to disclose because we haven't published recent holdings, we are able to find stocks in the mid-cap area that have been sold far beyond what we think is warranted, where the managements have taken a step for cutting the capex and shrinking working capital, so these stocks should be in the position to keep financing themselves and benefit hopefully from some turnaround in growth.
You are also betting on the fact that there will be a turnaround in the investment cycle. When do you expect that turnaround to happen?
Well, I think in the second half of the year we should see the order momentum improving for a number of corporates. You probably for the first time in many years have seen some of the more interest rate sensitive companies put in 30% decline in revenues. That's pretty unheard of in a fast-growing economy like India. So hopefully some of that year-over-year comparison will help as well. And again, it is a question of liquidity.
Because that's where India is lagging right now, and a lot of companies from the capital goods or engineering space, companies like L&T, BHEL, we often hear that there is a lot of interest given that these are marquee names. But because the industry is going through a slowdown, there's a sense of avoiding the companies right now and avoiding investment in these companies. Do you share that view?
I would characterize all these companies as very complex entities.
Okay.
Whether you take it L&T or any of the engineering names we brought about, they all have a large portfolio of projects. Whilst on a 20-year view, these projects may become profitable, you will have to keep financing, keep issuing to keep some of these projects alive. In some cases, promoters have been very lucky in finding private equity backers that were buying in a number of projects that we would deem at very high valuations. But again, to see that story continuing, you need to see probably simplification of some of the structures and reining in of the ambition, because what you have today on the balance sheet is more than enough.
What about the banking in the auto space in India? Since you spoke about interest rate sensitives, there's been much talk about the bad loan situations on some of the state-owned banks. Private banks, of course, looked upon with a little more interest. And then you have the auto space where you have two-wheelers, you have four-wheelers, and you have the commercial vehicles, the passenger vehicles and the commercial vehicles. How are you finding your way into investing in either of the entities?
Sure. Well, we have a couple of holdings in Indian financials. Among them would be Yes Bank. We take a more sanguine view on profitability, and the bank is growing at a fast clip, and clearly is a beneficiary of the reserve requirement cuts. In the auto space, we have found better opportunities elsewhere. We own Honda globally, we own Fiat. These are companies that, in our view, are as EM focused and have more compelling valuations. All of that said, clearly Tata Motor has done spectacularly well, we again keep a very keen eye on the market.
But what's the risk for India? What is the primary risk to your mind when you are looking at investing in India?
Primary risk is external. I would say it's a story of an outflow.
Not the politics, not the fiscal deficit, the balance sheet issues.
Clearly that is important, but what is outside of your control? What is outside of your control is the global environment. India is very vulnerable in a scenario of very low growth and the risk of market environment. So we need to see that being clearly a remote left tail risk, right, to say that one has a very sanguine, a very positive environment. Clearly the government has got a wake-up call with a market reaction on the initial refusal to sign the retail foreign ownership bill, that some of the decisions have been reversed. Clearly a move against corruption is a very positive one. Midterm, I think it'll be very myopic to say that this is negative for the market. This is positive because ultimately, although the time to market for some of these corporates may be longer, the rules of the game are more transparent. So as public shareholders, we very much welcome that type of action.
Well, we appreciate your time, Masha. Thanks very much for speaking with us.